What if a single form mailed to the IRS within 30 days of a date you might not have even circled on your calendar was worth more than your next 3 years of bonuses combined? For the right person, that is not a stretch. It is one of the shortest documents in equity compensation and one of the most expensive to get wrong. If you have restricted stock that vests, or options you can exercise before they vest, this one form decides whether years of growth get taxed as ordinary income or as a single long-term capital gain. The difference can run into the hundreds of thousands of dollars, and the window to file is 30 days with no second chance. Today, I'm going to walk through what the 83B election actually is, who needs it, the 30-day deadline you cannot miss, the tax math that makes it so valuable for pre-IPO equity, and when it is the wrong move. If you are at a startup or a pre-IPO company with restricted stock or early exercisable options, this one is for you. Let's get into it. When you receive stock subject to a vesting schedule, the IRS does not treat it as fully yours yet. There is what they call a substantial risk of forfeiture, the tax term for the fact that you could leave or be let go before those shares vest. The default rule taxes you as each tranche vests, not when you sell, when it vests. And you are taxed on the difference between the fair market value at that moment and whatever you paid at ordinary income rates. For a stock that climbs in value, that default is rough. Every vesting date becomes a taxable event measured against a price that keeps going up. The 83B election flips the timing. It tells the IRS, tax me now at grant on the spread between today's fair market value and what I paid, and treat everything after that as a capital asset. Here is the magic. If you acquired the stock at its fair market value, which is exactly what happens when a founder buys at par or an employee early exercises at the strike price, that spread is zero. Zero spread means zero tax to make the election. And from that point on, all the appreciation is capital gain, taxed only when you sell, eligible for long-term rates once you have held more than a year from grant. So who is this actually for? Because it is not everyone with equity. The 83B election applies in one specific situation. You hold stock or you can buy stock that is subject to vesting. Founders are the classic case. They buy restricted stock at incorporation for a fraction of a cent, file the election, and every dollar of future growth becomes capital gain. Early employees who get restricted stock awards are in the same position. The bigger group at Bay Area tech companies is option holders with an early exercise provision. Some plans let you exercise your options before they vest. When you do that, you receive stock that is still on the original vesting schedule, and the 83B election is back on the table. We've talked about the differences between ISOs and NSOs previously, and that distinction matters here, because for ISOs, the election also locks in the alternative minimum tax measurement at the exercise date instead of at each vesting date. Now, here is who this is not for. If you hold standard RSUs at a public company, this election does not apply to you. RSUs are taxed at vesting by design, and there is no property transfer at grant to elect on. The 83B lives in the world of restricted stock and early exercise options, which is the pre-IPO equity a lot of you are holding right now. Now the part that ends most 83B stories before they even start, the deadline. The election has to be filed with the IRS within 30 days of the date the stock is transferred to you. For restricted stock, that is the grant date. For early exercised options, it is the exercise date. 30 calendar days, not business days. The clock does not stop for weekends, holidays, the week you were closing on a house, or the week your kid was sick. And there is no extension and no late filing relief. If day 31 arrives and you have not filed, the election is gone, and so is every dollar of planning that depended on it. The mechanics themselves are simple, and that is part of the trap. You sign the election statement, you mail it to the IRS office where you file your return, and you keep proof of mailing. That's it. The form is short. So the failure is almost never a wrong decision. It is a missed date. Someone early exercises in the excitement of a new grant, fully intends to send the paperwork in, and looks up 40 days later. By then, the most valuable move they had was already gone. If you take one thing from this video, take this. The moment you acquire vesting stock, the 30-day clock is already running. Let me show you why this matters in real dollars, because this is the part that turns a boring form into a six-figure decision. Take an early employee who buys 100,000 shares of restricted stock at 2 cents a share, when the market value is also 2 cents. Total cost, $2,000. The spread is zero, so filing the 83B costs nothing in tax today, and it starts the long-term holding clock right at grant. Fast forward 4 years. The company goes public. Those shares are now worth $25 each. With the election in place and more than a year of holding, the whole thing is a long-term capital gain on roughly $2.5 million. Taxed at the long-term rate, plus the net investment income tax, plus California's tax on gains. Now run the exact same grant without the election. The stock vests in equal pieces over 4 years while this price climbs. Say $4, then $10, then $18, then $25. Each vesting tranche is ordinary income on the fair market value at that moment. Add it up and you're looking at well over $1 million taxed at the top combined federal and California ordinary rate. Not the capital gains rate, the ordinary rate, which for high earners runs north of 50%. The spread between ordinary income and long-term capital gain treatment on 7 figures of appreciation runs into the hundreds of thousands of dollars. That is the entire reason this form exists and the entire reason the 30-day deadline is worth obsessing over. Now, let me be clear. The election is not free money and it is not always the right call. It is powerful when the value at grant is low and you believe the stock will appreciate. Early stage equity, where the spread is small or zero, is the textbook fit. You pay little or nothing now and convert future growth into capital gain. It can also start the 5-year clock on qualified small business stocks sooner, which is its own potential benefit and a separate conversation. It stops making sense when the spread at grant is already large. If you make the election on stock that already has a big built-in gain, you owe ordinary income tax now in cash on shares you cannot sell yet. That is the same illiquidity trap we've talked about with pre-IPO option exercises. And here's the deeper risk: forfeiture. If you pay tax under an 83B election and then you leave before the shares vest, or the company simply does not make it, you do not get that tax back. The income you already recognized is not refundable. Your loss is limited to what you actually paid for the stock. You bet on the upside, you prepaid the tax, and the bet did not pay off. So the real question is never just, is the election good? It is whether the value at grant is low enough, your conviction is high enough, and your cash position is strong enough to make prepaying that tax a smart trade. So here's the bottom line. The 83B election is a 2-page form with a 30-day fuse. For the right pre-IPO employee with low basis, appreciating stock, and the cash to prepay the tax, filing it on time is one of the highest return administrative acts in all of equity compensation. For the wrong situation, it is a prepaid tax bill on stock that might never vest. The form is short. The thinking behind it is not, and it has to happen before day 30. If you want to talk through your specific situation, the link to schedule a call is in the description. And if you haven't subscribed to Vested yet, my weekly newsletter for Bay Area tech professionals, the link for that is down there too. I'll see you next week.